Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of interest rate risk. Protect your investments from market shifts. Are your investments safe from interest rate fluctuations? Interest rate risk can significantly impact the value of your portfolio, making it crucial to understand and manage. Investors need to stay informed about how changing rates influence different asset classes to make smarter decisions. In this video, we'll explore the basics of interest rate risk, how it affects various investment types, and share strategies to protect your investments. Whether you're holding bonds, stocks, or real estate, knowing how to navigate interest rate changes can save you from potential losses. Let's dive into the specifics to help you safeguard your financial future. Understanding interest rate risk. Interest rate risk is a crucial concept to grasp when it comes to managing your investments effectively. Let's dive into what interest rate risk entails, how it impacts investments, and which types of investments are particularly susceptible to this risk. Definition of interest rate risk. Interest rate risk refers to the potential for changes in interest rates to negatively affect the value of an investment. In simple terms, as interest rates fluctuate, the value of certain investments can rise or fall, leading to potential gains or losses for investors. This risk is prevalent across various investment vehicles and is a key consideration for investors of all levels. Impact of interest rate changes on investments. Interest rate changes can have a significant impact on different types of investments. For example, when interest rates rise, bond prices typically fall, as new bonds are issued at higher rates, making existing bonds with lower rates less attractive. On the other hand, some stocks may benefit from rising interest rates, such as financial institutions that can earn more from lending at higher rates. Types of investments affected by interest rate risk. Various investments are vulnerable to interest rate risk. Bonds, especially long-term bonds, are highly sensitive to interest rate changes. Real estate investment trusts, REITs, can also be impacted, as their borrowing costs may increase with rising interest rates, affecting their profitability. Additionally, stocks of companies in interest rate-sensitive sectors like utilities and homebuilding can experience fluctuations based on interest rate movements. Understanding how interest rate risk can influence different investments is crucial for building a diversified portfolio that can withstand market fluctuations. By being aware of the impact of interest rate changes and the types of investments affected, investors can make more informed decisions to navigate the ever-changing financial landscape effectively. Strategies to manage interest rate risk. Interest rate risk can have a significant impact on your investments, but there are strategies you can implement to help mitigate this risk. By diversifying across asset classes, using bonds with varying maturities, and utilizing interest rate hedging instruments, you can better protect your investment portfolio. Diversification across asset classes. Diversification is a key strategy to manage interest rate risk. By spreading your investments across different asset classes, such as stocks, bonds, and real estate, you can reduce the impact of interest rate fluctuations on your overall portfolio. Using bonds with varying maturities. When it comes to bonds, choosing securities with varying maturities can help you navigate interest rate risk. Short-term bonds are less sensitive to interest rate changes than long-term bonds. By holding a mix of short-term and long-term bonds in your portfolio, you can better manage the impact of fluctuating interest rates. Utilizing interest rate hedging instruments. Interest rate hedging instruments, such as interest rate swaps or options, can provide additional protection against interest rate risk. These financial products allow you to lock in or hedge against interest rate fluctuations, providing a level of certainty in an uncertain market. Incorporating these strategies into your investment approach can help you better manage interest rate risk and protect your portfolio from unexpected market volatility. By diversifying across asset classes, using bonds with varying maturities, and employing interest rate hedging instruments, you can take proactive steps to mitigate the impact of interest rate fluctuations on your investments. Assessing interest rate sensitivity of investments. In assessing the interest rate sensitivity of investments, two key measures come into play: duration and convexity measures, and interest rate stress testing. Duration and convexity measures. Duration is a crucial concept to understand when assessing how changes in interest rates can impact the value of investments. It measures the sensitivity of a bond's price to interest rate changes. Longer duration bonds are more sensitive to interest rate fluctuations, while shorter duration bonds are less affected. Convexity, on the other hand, takes into account how a bond's price changes in response to interest rate movements beyond what duration predicts. It provides additional insight into the potential risks associated with interest rate changes. Interest rate stress testing. Interest rate stress testing involves evaluating how different scenarios of interest rate changes can affect the performance of investments. By stress testing a portfolio against various interest rate environments, investors can gain a better understanding of the potential risks they face and make informed decisions to mitigate those risks. Understanding the dynamics of duration and convexity measures, along with conducting comprehensive interest rate stress testing, is essential for investors looking to manage interest rate risk effectively in their investment portfolios. Interest rate risk is a fundamental concern for investors, as fluctuations in interest rates can significantly impact the value of various investments. Understanding how interest rate changes affect different asset classes and implementing strategies to mitigate these risks is crucial for protecting your investment portfolio from market shifts. Interest rate risk primarily affects fixed income securities such as bonds. When interest rates rise, the value of existing bonds typically falls because newer bonds are issued at higher rates, making the older, lower-yielding bonds less attractive. Conversely, when interest rates fall, the value of existing bonds generally increases as they offer higher yields compared to newly issued bonds. This inverse relationship between bond prices and interest rates means that investors need to be mindful of the duration of their bond holdings. Duration measures a bond's sensitivity to interest rate changes. Bonds with longer durations are more susceptible to price fluctuations than those with shorter durations. To protect against interest rate risk, one effective strategy is to diversify bond investments across various maturities, a technique known as laddering. By holding bonds with different maturity dates, investors can reduce the impact of interest rate changes on their overall portfolio. As bonds in the ladder mature, the proceeds can be reinvested at prevailing interest rates, potentially enhancing returns over time. Floating rate bonds, also known as variable rate bonds, are another option to consider. These bonds have interest payments that adjust periodically based on a reference rate, such as the LIBOR or the federal funds rate. As interest rates rise, the interest payments on these bonds increase, providing a hedge against declining bond values in a rising interest rate environment. Equities can also be affected by interest rate changes. Higher interest rates can increase borrowing costs for companies, potentially reducing their profitability and, consequently, their stock prices. Additionally, higher rates can make bonds more attractive compared to stocks, leading to a shift in investor preference. On the other hand, lower interest rates tend to boost economic activity and corporate earnings, positively influencing stock prices. To manage interest rate risk within an equity portfolio, investors can focus on sectors that are less sensitive to interest rate changes. For instance, utility and consumer staple stocks often perform relatively well during rising interest rate environments because they provide essential services that remain in demand regardless of economic conditions. Additionally, companies with strong balance sheets and low debt levels are generally better positioned to withstand higher borrowing costs. Real estate investments, particularly real estate investment trusts, REITs, are also influenced by interest rate changes. Rising interest rates can increase mortgage rates, potentially slowing down real estate activity and affecting the profitability of REITs. However, real estate can serve as a hedge against inflation, which often accompanies rising interest rates. Investing in diverse property types and geographic locations can help mitigate the impact of interest rate fluctuations on real estate holdings. Cash and cash equivalents, such as money market funds and short-term certificates of deposit, CDs, are typically less affected by interest rate changes. However, the returns on these investments are often lower compared to other asset classes. Keeping a portion of your portfolio in cash and cash equivalents can provide liquidity and stability, allowing you to take advantage of investment opportunities that may arise from market shifts. Another approach to managing interest rate risk is through the use of financial derivatives such as interest rate swaps and options. These instruments allow investors to hedge against adverse interest rate movements by locking in current rates or by gaining the right to benefit from future rate changes. Derivatives can be complex and may require a deeper understanding of financial markets, so consulting with a financial advisor is advisable before incorporating them into your investment strategy. In conclusion, protecting your investments from interest rate risk involves a multifaceted approach that includes diversifying across different asset classes and maturities, focusing on sectors less sensitive to rate changes, maintaining liquidity through cash and cash equivalents, and considering the use of financial derivatives. By implementing these strategies, investors can better navigate the challenges posed by interest rate fluctuations and safeguard their portfolios from market shifts. By incorporating these analyses into their decision-making processes, investors can enhance their ability to navigate the complexities of the financial markets and optimize their investment outcomes. Stay tuned for part 2 and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.